But it's earnings season, so let's get straight to the next management. It was a soft quarter coming in for Sterlite Tech. Revenue growth was weak. The order book continues to remain flattish, although margins expanded. The company has lowered their FY24 guidance to around 7 to around 9% from around 10 to 12 earlier. Ankit Agarwal, the MD of the company, joins us on the show. Hi, Ankit. Good morning. Well, you've lowered your guidance, but you're still sounding reasonably optimistic because 7 to 9% in comparison to 10 to 12%. So give us some details. How do you see this shaping up? And also give us a trajectory on margins from here on.
Hi, thank you for having me on the show. So as you said rightly, earlier we had looked at full year basis, we had looked at 10 to 12% earlier, versus now when we see the market and our conversations with our customers across Europe, across US in particular, we now see that we are now forecasting between 7 to 9% growth. As we had shared earlier as well, fundamentally, we continue to see quite strong demand, particularly for the optical fiber on the back of 5G, fiber to the home, and the hyperscalers. What we do see is that there is some inventory, particularly in the US market. And result of that, there is some period of time as that inventory gets depleted over the Q1 and Q2. We do see that we will see improvements in our sales volumes, particularly in US and also to a smaller extent Europe, as we get into second half of this year. So on the back of that, we found it prudent to look at the guidance, and we've reduced our guidance accordingly. In principle, we are also looking at how do we scale up in other geographies, particularly in India, where we do see strong demand continuing on the back of 5G. And probably towards the end of this year, we should see some demand coming on the back of BharatNet kind of projects.
Ankit, hi, good morning. Prashant here. What does this mean for, so it's an inventory issue, as you explain it. Otherwise, demand trends remain pretty strong from a longer term perspective. But what does this mean in terms of pricing, what you're able to charge, and then margins for the full year?
Yeah, absolutely, Prashant. So as we shared, so our margins have been healthy. We've actually taken a very strong look at our costs and looking at our cost to serve our customers. Definitely, there have been areas where we continue to focus and improve our efficiencies. We've also seen now some of the logistics costs come down and some of the raw materials have stabilized. So we are looking at all the elements of if our volumes come down, which we have seen in Q1, we may see it continue in Q2. We are taking several measures to reduce our costs as well. So to that extent, we are holding on our margins. Currently, the price realizations continue to be stable, but we may see some of that coming down in Q2 and maybe partly in Q3. Overall, we are still looking at how to continue our profitability, particularly in our optical business, which is north of 20% EBITDA margins.
Okay, got that, Ankit. So, let's now just talk about the overall growth picture. As you're mentioning, at least on the volume side, there's not much problem in the optical fiber business. Let's talk about services as well, where I think the stated intent is to, be a little more selective in the kind of contracts that you execute, the kind of works that you execute. And I believe that you were expecting a pickup in the UK markets. So talk to us a little more about services. And in terms of the revenue pie, FY24, how much will come from both of the segments?
Sure, absolutely. So at a macro level, we are in the business range of around 6,800, 7,000 crores if you look at last year. And so broadly about 1,700 crores of that came from the services business, and largely the balance came from the optical business. So from a split perspective, probably that kind of ratio will continue. What we have guided specifically is that we are very focused on taking certain projects at the right margin level. So that discipline is definitely now in the business, taking business at the right margins, right kinds of customers, and most importantly, ensuring that the cash and the fund involvement improves. So that's the focus that we're doing, as we guided yesterday as well, particularly in some of our government projects where we are now looking to hit certain milestones. We do believe that probably by second half of this year, we do see us hitting some of those milestones and generating more cash. Broadly, we have moved from a range of about 3 to 4% margin to closer to about 7 to 8% margin. So that's something that we'll continue to drive going forward. One big trigger clearly will be, BharatNet kind of projects where there's about 80,000 crores spent by the government, and STL will look to play a leading role. Similarly, NHAI has now talked about anywhere between 10 to 20,000 kilometers of highways being built, where there will be a fiber core at the heart of those highways. So some very interesting projects that are coming up in India as well. We will be very selective in which of these we pick up. On the UK side, there has been some consolidation of the internet service providers in the UK, which has led to some temporary reduction in deployment in the UK. So we continue to be bullish on the UK, but I think when we look at Q1, there was some slowdown. We see that probably picking up by certainly by H2 and probably by Q2 itself.
All right, Ankit, so we've got a fair idea about the operational performance. What's the updated debt number and reduction plans from here on?
So broadly, we've been at a flat level of debt in the range of around 3,200 crores net debt. And we continue to, while we talked about our revenue guidance going 7 to 9%, we continue to maintain a target of going to net debt to EBITDA of 2.5 times. So as we said, our focus on the business is now to clearly generate cash and to reduce the debt going forward.
Ankit, just a question on the margins, because from what you described, on the optical fiber side, pricing may come off a little bit. But on the services side, you're very focused on winning high margin orders. So net at a blended level, you're at 13.4% roughly right now at the end of Q1. What's the margin outlook? What's the range that you'd like to see the company at?
I wouldn't be able to give a specific number, but I think definitely, as I said, on optical side, we want to maintain EBITDA north of 20%. And we want to specifically look at services margin being north of 8% and eventually take it to 10%. So that's clearly a priority for us. And the second one is to look at the cash generation across the businesses and reduce the fund involvement.
Okay. Speaking of funds, just want to check this. I believe that you're planning a rights issue as well at some point this year. Can you give us some more idea if you are looking to raise any further money? What could be the size, quantum, and why would you want to raise more equity?
So as I said, firstly, our target is to take the net debt to EBITDA to 2.5 times. That currently does not factor a rights issue. That is through our cash generation of the business. We are continuing to evaluate the opportunity for the rights issue at probably the right market conditions and looking at the business requirements. We'll continue to evaluate that.
Ankit, we'll leave it there. Thank you very much for joining us. And it's always a pleasure having you here on CNBC-TV18. That's the management of Sterlite. Tech stocks absolutely flat this morning. Well.